Welcome back to Rockstock Channel. It is May 1st, Wednesday, 8:40 a.m. And we're very privileged to have back to Rockstock Channel, uh, James Brown, the interim CEO of Sayona Mining. It's been many, many years since we had James on the podcast when he was at Altura. Uh, RK Equity is not a strategic advisor to, nor invested in Sayona, but we were a strategic advisor to and investor in and capital raiser for Altura back in, I think, 2017. You and I, James, met, I think, at the Fast Markets Conference in 2016. And Altura, was ahead of Pilbara back in the day in getting up and running. I visited the site. Thank you very much. Chris Evans was your chief operating officer, now the CEO of Winsome Resources. That was the first time I met him. And I remember him driving me through the Pilbara, and we were talking about the lithium bull and how he liked my rock music analogies, back then. Um, but I visited Sayona, I think, in late 2022, when there was a big site visit you and Piedmont or Brett Lynch, had organized. And there was like some nice dinners and pictures we had with Brett Lynch back then. But I ran into you, to my surprise, at that event, and also tweeted then that I took great comfort in the fact that one of the few people who's actually successfully built a spodumene mine was involved in the restart of North American Lithium, a mine which has a very bad reputation in the industry, having failed, I guess, under Canada Lithium a number of years ago, and then later under CATL. However, we do know that this mine's been in operation, since the 40s and the 50s, before Kings Mountain and, the North Carolina mines were going. America was fed by this mine. It was under Eisenhower when they said, we can't trust Quebec, with our lithium. We need to develop our own lithium resources. But this was financing the hydrogen bomb, back in the day. So this mine has a long storied history. You have provided, or Sayona has raised a lot of capital. Piedmont has invested capital. You've analyzed all of the, issues, the past issues. And, but before we get there, I knew Brett Lynch and Sayona when it was just the OTA project, and it was a 20 million market cap, and they were a long shot, dark horse to win this project with the help of Piedmont connections and money. Sayona won, and the stock went on a tear, from 20 million market cap to well over, $1 billion market cap. The company has since, made an acquisition of Moblon, which we're going to talk about. But, and Rodney is going to get into details here. It's great that you're speaking now. You just put out your quarterly report. We've been talking about having you on for a few months now, and really appreciate now is a good time to kind of have this conversation. I want to thank all the Sayona shareholders who responded to my invitation. 8 of you sent a list of very detailed questions. And by the way, anyone watching this, please feel free to email rockstockchannel@rkequity.com if you'd like to ask questions. Rodney and me, you have any ideas of guests that, we'd like to have on, and we'll put that on there. Sayona Mining does have a very active X presence. At Sayona Mining is their handle. And every time, I tag it, I tend to get a lot of likes and views and retweets, as I did when I asked investors to submit questions to you. So the ticker symbol for Sayona is SYA on the Australian Stock Exchange, and they also have an OTC listing, SYAXF. Just a reminder, we're not investment advisors, so nothing you're going to hear is investment advice. As I mentioned, we're not advisors to Sayona. We have been advisors to Piedmont, as anyone watching this channel has known, and we are invested in Piedmont. The valuation discrepancy, there was always like a high discrepancy, I think, between Sayona and Piedmont. That's largely kind of gone away. And I think the valuation actually of Sayona at some $250 million is quite cheap. You have shared with me, James, thank you, research. You have an eclectic following of sell-side analysts. Canaccord's Red Spencer, who we've had on the program, recently upgraded you from a hold to a speculative buy and a 6 cent price. I think you're trading around 3 cents. But Desjardins, like a Quebec-based shop, has a target price of 15 cents. And Petra Capital, who is responsible for your $200 million capital raise last year, which was at 18 cents. And Brett and Sayona got a bit of flack for, having raised money at that point. But I think in hindsight, it was very good that you did at that price. But they have, I think, a 15-cent target or thereabouts. The market's giving a great deal of valuation to the North American lithium asset, but Moblon, which we're going to speak about as well, which you have a DFS for, also, I think I'm looking at Desjardins. They're valuing the Abitibi hub at 15 cents, Moblon at 17 cents. And then, they're discounting, risking those to, I forget, at a 60%, of their, fair value. Anyhow, I want to start, Rodney's going to get into like kind of greater detail about things, but just based on your experience with, Altura, and there's not a lot of CEOs that have skills as an operator. I remember looking back, Pilbara had a lot of issues ramping up, as did Altura. Like it took 2 years before recoveries. I remember like it was 2020 and Pilbara still recoveries were, in the mid to high 60s, multiple years, into production. So how does the ramp up, to nameplate at North American Lithium compare to what you experienced at Altura, and Pilbara, and what lessons, I guess can be drawn from that?
Yeah, I appreciate that, Howard, and certainly a great introduction and good. We keep in touch and bump into each other, but we've just been all hands to the pumps of late, and catching up with Rodney again. It's great analytical perspective on these operations, particularly globally. And I think, to any CEO's defense and anyone's engaged in this business, we tend to focus on our own backyard first and don't see a lot of what the peer groups are doing at some point. But it's great when people can round us up and we can have a comparison and see where we are and compare. I think particularly from a ramp up perspective, and these are always challenging. And I think for us particularly, one of the differences between Pilgrim and ourselves at NAL is really that we were starting with new equipment, a new process design. We were testing and pressure testing a number of concepts, because we did have a combined DMS and flotation plant, which was closed circuit, and the DMS wasn't giving us any issues per se, but the flotation was in order to get to the target recoveries in the low 70%, which are quite high at the time. I must admit, when I first looked at our let's say, our pilot testing for NAL, and, I appreciate the history of NAL, and, we're always proud that we left the name of North American Lithium on there. I think it's a great name, and it certainly has got some history, and that has some positives and negatives. But what we're looking at is a complete refit of that plant. Some of the restrictions and some of the areas you've seen our capital spend continues where, it will trail out from here on, but there has been some, legacy items that we've had to deal with. And one of the, I think probably if we look at the top down and I find this this will be very good, Rodney? It's probably the first time Rodney and I probably won't discuss recovery from a negative standpoint. We're at or above a design recovery, which has always been difficult for ramp ups. And we can tend to get the throughput from a tonnage per hour basis. We can tend to get the head grade right or wrong or similar within a tolerance. But when it comes to recovery, it's material that's lost into the tailings. And from North American Lithium, we've started off with a reasonable target. And as I said, 67 odd percent in the early days is a fair stretch for a single, let's say, a solely froth flotation operation. We've been, and the team, and when I say we are, I mean we as the team there and as the operators have worked tirelessly, as have our partners, as you know, Patrick Brendel in Piedmont has been a great advocate and former DRA executive. So we're using every resource we can get, but it's really worked out quite neatly from that perspective. The challenges have been really on reflectance is the retrofitting of new equipment into the older shell of the plant. And we're seeing that particularly from the primary crusher has been a fair bit of investment or a significant investment, and opening the aperture, the feeders, new feeders in there for the crusher, a number of items that we're trying to improve the consistency of the throughput. I've told people probably a few times, Howard, that the plant's in two halves in my mind. There's the crushing and grinding circuits, and then there's the process and concentrating circuits. We're finding our process and concentrating circuits are working as at design, if not above our expectations. So that hasn't been, when you look at the differentiation in ramp ups, that hasn't been an issue. What we've looked for is stability in our crushing circuits and also working in the weather conditions we have. And certainly by opening up the feed process in the primary crusher, we introduce flow rates into the plant that it hasn't seen before. And obviously there's some limited, let's say, redundancy we could build into the crushing and grinding circuits. We have two rod mills, a cone crusher and a primary jaw crusher on site there. So we've looked at what we did at Pilgrim, and one of those things was, when we can crush material, if the plant's down and the crusher's still working, we'll crush ore and we'll stockpile that separately. And then we've got a refeed system that we recently implemented in February, which is helping us when the primary crusher is down, we can feed and bypass around that unit now. And then obviously the commissioning during April and full commissioning and operation of our crushed ore dome, which will give us fresh, clean ore in a crushed format so that we can, move around the limitations of the retrofit style of the plant. So that's been the primary difference. I think one of the things we've looked at as well has been, I think particularly from our perspective, is the frothing of the product's been very, very good. Hence the recovery is where it's at. The product coming out is consistent. I think, Howard, you and I, we would all knew about the previous reiterations of NAL and, inconsistency in the product, sometimes lower grade, sometimes a bit higher. That's been one of the pleasing parts. So we are, we sell around 5.4, 5.5%. That's the best grade for us to produce from a cost benefit perspective through NAL. The only other side, I suppose, has been the mining side. And one of the learnings we did have at Pilgrim and Altura was these plants like to run 24 hours a day, 7 days a week, and they like to run on primarily consistent products. So we're able to use let's say a recipe, as we call it, for our these are bucket fed, let's say ROM feed into the plant. So we campaign areas, so we've got sufficient stocks of similar type of product. So there isn't a requirement to keep moving the settings around the plant and keeping some consistency through it. The only other challenge, I think one of the key ones has been, and you touched on it before, I think it was very little known that North American Lithium was previously the site of several underground operations producing spodumene, as you said, for, looking at the war effort and those periods in the 40s and the 50s. The way the mine plan is working, we are working through those old underground stopes at the moment. We're finding a little bit of inconsistency where they're supposed to be and where they aren't, which is really increasing or decreasing our productivity in the mine itself, and certainly hauling the until we get some new permit approvals. But all in all, the the difference of operating, and I forget the metric, apologies for the metrics, but, working at plus 45 degrees and minus 45 degrees is significantly different. But the team there's done an excellent job under Sylvain Collard, who's our COO of Sayona, and obviously the COO and site manager for NAL.
I wanted to just ask, you had very good drill results recently, and Keith has talked about, this ore body has just a bad reputation as not the best ore body, but in terms of size and quality over time, you just mentioned, on the underground stoping, but the drill results, et cetera. I mean, is this, going to get a lot better over time? That's one question. The second question is, there was also has been talk, about the quality of the water, in Quebec, because we understood that in Western Australia, there's a lot of salt water, that impacted, at Pilgangoora. So, in terms of recoveries and productivity there, could you comment on those two aspects?
That's a good reminder. I think, again, looking at North American lithium before and after, I would say it's not a complex ore body structurally when I see it, but obviously it has what we call like stringers. So the dilution and mining from the area, we have to cut it reasonably hard because we can't add the black or the mafic material into the process. So we are looking at, and have been sorting up on the ROM pad to get a cleaner feed. So we are feeding in reasonably better grade than has been there before. And that's probably a function of two things that we're selectively mining. I think our process and our blasting practices we brought across, allowing the dilution to be minimized. And the second part is we are in a phase which holds the old underground workings, and the old timers, the miners, never started at the worst part first. So we are, experiencing the trade-off of lower productivity is that we get higher head grade coming into the plant. So you've got to follow these guys because they're very, very smart. I think what you touched on there, Howard, is we have had a reasonable campaign of drilling at NAL, and I think dovetailing into what you said about its history as Canada Lithium and RB Energy, and then the subsequently reopening as North American Lithium, and we didn't destabilize by changing the name for a fourth time. But the data set we were looking at, the data set where we purchased the operations in 2021 was fairly aged. I mean, no one had the capital, the market was down, people weren't drilling holes, and we were able to raise some money through the wonderful flow-through system, as you're aware of, and we were able to apply some of that to the outer areas. And what we found and what we have reported, it's not under the table information, what we have reported is significant intercepts outside of the main ore body and outside of the main pit. And one of those which, surprised me, I think it ranked about number 3 of intercepts last year, was 60 meters at true thickness at 1.6% under the main ore body. And we have a section there, and where the summer campaign will track that up dip, because we believe we'll find that up dip and we'll find, where we can access that. And I think that gives us opportunities, not to get ahead of ourselves, but looking at the reserve base and the let's say the mineral resource base that we've got there has significant upside, and that's purely by the intercepts that we've got there and we've published. Now, those were never tested before, and we have tested them. We've had reasonable discovery, very similar to Moblan, where it was a reasonably relatively small unknown deposit, but a different mindset, thinking outside the box, drilling in other areas, looking at the remote sensing information we had to lead to significant discovery. So I think that gives NAL particularly the option for longevity, along the long mine life from where we thought. The other trigger, I suppose, is that we have the Ortier project there that is, in the midst of an approval process and has been for a little while, was, set aside to be a supplementary ore feed supplier to NAL. Well, obviously, the more we discover, the pressure on that timeline starts to move away. So for the moment, we're quite enjoying the feed we've got. I think the discovery there has been quite significant, and there's more to come. We'll have an upgrade of the MRE in the coming months when the team get through the receipt of all the core samples and the assays. So there is some upside for that. As for the water, anyone that hasn't been to that part of the world, and we are a Quebec focused operation, but and I think the other part is most discoveries up there feature the name lake. I mean, if you look across from Ontario all the way through to Quebec, a lot of deposits are called lakes, or have the suffix of lake because there's a lot of water up there and water mass. We did have at Pilgrim, I wouldn't say it was hypersaline or saline, but we did have a requirement for our froth flotation to run through a reverse osmosis plant and feed in chilled water. Whereas we do the same there, but it's much more efficient and the water feed is much cleaner. So the makeup water that we're getting back from the tailings, the settlement time or the residual time for settlement is quite low. It is a good environment from a liquid input perspective, certainly.
Okay. And last thing for me for the moment before Rodney digs in deeper. Look, so there's the mine operating cost that is a focus, and with the crushed ore dome and the refeeder and other activities, that's improving. But your last quarterly shows that your costs went up. So Rodney will dig into that, a bit. But so there's the cost of mining. That's one thing, but then there are transport costs that, like iron ore, when prices are as low as they are, a freight differential when you're selling to China, it is a big difference. You are the kind of best located, as Keith Phillips always says, the best located project in Quebec. You are close to infrastructure, but nevertheless, transport costs to China are, I don't know what they are, 150, 200, $200, or you can clarify that. And then the third thing, from profitability and decreased cash burn perspective is what price you're receiving, right? So you've been receiving, Sayona's been receiving a low price, you've had high costs, but so you burn cash in the quarter, but, we think, and we'd like to hear that, there's a turn here, on the cost side, but also on your realized price. So if you could just talk about those things, and Rodney will go a bit more into detail.
Yeah, and I think there's a fluctuation looking and certainly when you look at the cost of ton sold, you start to wind in inventory movements as explained into the and Dougal Elder, our recently appointed CFO, is the best one to explain it in accounting speak. But essentially, we've had some unforeseen events occur in the first quarter, which related to weather. And I mean, people are fair to say, but you're always going to have these snow and rainfall events, but we didn't expect them in such close proximity or intensity. But it's a combination of things that we've had to do to develop and commit to the ramp up. And, I know our discussions with Peter and Keith particularly is based on the joint venture committed to the ramp up. We're not there yet. I think one of the key drivers, or if not the key driver for us, is getting our tonnage up to the nameplate level. And when we're looking at a March number, we were hoping to be north of 15,000 tonnes per month of our material at 5.5%. By the end of March, we exceeded that by getting to 16,000 tonnes during March. Each quarter on quarter, there's been I wouldn't say rapid, but substantial improvement on the previous quarter in regards to tonnage and recovery. Outside of that, obviously our major cost on site is our mining cost. And under the arrangements we have with our contractor, we're having to move material further away than was anticipated. And that's, we hope that by in the second half of the year, the receipt of some additional permits, and we're going through the process that we can change our hauling arrangements and start to reduce those costs. Howard, you are correct. Once, I suppose there's the cost when it comes to transport, really I look at it in two parts or two or three. There's the loading and unloading, which everyone has to have. And then there's the actual cost per ton per kilometre as we actually have to move our material to another location, in our case, from north to south to the port of Quebec. But I think probably one of the keys that drives, particularly with the freight rates to overseas destinations. And at the moment, if we're looking at conversion capacity, most of that, still remains in North Asia. So we're looking at freight rates, which are as you said, north of 100, and certainly towards mid $100 to have the material transported from north to south. So that's a significant bite into anyone's cost of production. So from our perspective, we need to, I think, we've given ourselves some time to complete the capital projects, which are the refeed system. Certainly the tailings upgrade is not a nice to have, it's a necessity. And the crushed ore dome, which would really be of most benefit to us during the winter months. But coming online now gives us, as I said, the ability to increase our availability of or utilization of our say crushing circuits from the low 70s up into the 80s and pushing towards the 90%. Now that's the difficult challenge, but everything tells us, and our team are confident that the work that we've completed allows us to move through and get us up towards, ultimately the target between 18 and, somewhere between 17 and 19,000 tonnes per month, depending on maintenance schedules, will really start to bite in and lower the overall unit costs.
So, so James, just, I had some questions. You've given lots of good info there. When is it that you expect to hit a nameplate then consistently as a run rate?
Yeah, there's been no, obviously we look at our budget and for Australian budgeting purposes, we're going through that process at the moment because it'll run from the 1st of July to 30th of June. The JV is looking at those numbers now to determine, and we'll stress test those and have a conversation at the next meeting, and certainly that's been circulated as to where we think we are. As I think, the main one for us is the utilization of the crushing and grinding circuits of the plant is the one where we see the significant improvement. As I said, we'd set ourselves, and talking in my mind was by March to be above the 15,000 tonnes per month. And remembering sort of the latter parts of last year when producing 9 and 11, and that always seems a bridge too far, but we've got to that area now. We would think the second half of the year is really where we need to be pushing, the nameplate, where we see, and whether that's early or in the latter part, I would think we'll really know when we understand once we commission these alternate feed supplies that we've got there and the utilization of the plant. So in the not too distant future, Rodney, but there's no hard and fast date we've put on it yet.
And with that ramp, how is the operating cost going to look as you pick up? Can investors expect a lowering on the OpEx side?
Yeah, we'll put out some guidance. As I said, we've got 3 months. I think we revised the guidance last year, and it was pretty obvious to me that may have been a little bit optimistic. It's a requirement that we keep investors updated, and we will continue to follow through that with the key metrics. I think, as I said, I think really the April's complete now, so we've seen where we've got there, and that was significant. Milestone for us as well. And May and June will give us that confidence where we need to be for guidance for the next 6 to 12 months, I think, particularly on that. But I think when we look at pricing, the only, I suppose, Rodney, you're not sure from an analytical perspective. A lot of us look at the definitive feasibility studies and say, well, okay, that's what's been published and that's what we based it. And we did that at Altura. We had the DFS out, and that was always the number set in stone because your financing package hangs off it and all the other whistles and bells that go with that. With North American lithium and looking at the prices, I think the DFS was looking at a cash cost of around $710, I think, from a US perspective. That to me would be an ideal result for NAL, given its cost structure and the way the strip ratio works in its current form. So that's what we're working towards, those numbers, but those are the numbers that are published in the to the investors in the DFS, and those are the ones we're still working towards.
Okay, great. And for the sale of the product, the pricing strategy, and your thoughts around potential agreements for the sale of the non-Piedmont volumes going forward?
Yeah, I think, Rodney, we've gone through a process again from our experiences to try and get the product accredited into, multiple facilities. So, there is a hangover what has been sold in under previous operations as to what we do sell, and having consistency in the product and getting through that to multiple facilities. The first thing that we have to ascertain is what do we think that amount is in the remnant from the Petermont agreement. So if it's a guidance number, upper guidance number of 190,000 tonnes, then we need to subtract the 113,000 tonnes from that. So it's really topping and tailing what that number looks like. Certainly from our perspective, and it's not a Sayona decision, it's a joint venture decision what to do with what that material looks like. I think to be fair, the lifting schedule, it's we're all finding and testing the joint venture as we get into not quite, we've had 9 months now of operations of what material goes where. There's been, the lower pricing is reflectance of where the materials had to be placed. And I think we were, from a joint venture perspective, having to accept the cargoes earlier this year and probably the lowest part of the market hasn't helped, when it comes to let's say a price yield from that perspective. Most lifting schedules are always flexible. I think everyone would like to lock one in and sign it in blood, but that depends on a number of factors from where it is. So, looking at that, then, we know what the Piedmont agreement should yield in the current market, and looking at what we can do from that perspective to maximize the revenue coming into NAL. And, certainly both partners have always, to my mind anyway, we've always worked in what is the best interests of the JV and working together as we go through this, because we're both entering, both people and ourselves, both entering production together. Wouldn't say we're holding each other's hands, but we're together and we're learning as we go as to how we move about that. Now, there was, I suppose, what we're talking about offtake, you probably had a million emails, and I've had a lot of contact in regards to the offtake. And I think Keith made some statements that were, I think he said it's not overly complex, but people don't understand it. I agree with him 100%. It's a life of mine agreement. It does have the floor and the ceiling price. It does have a passive switch in there, which the decision to go downstream, and we fully support that process. Preference is given to supply to the plant on site or in another location. However, it's not a sale of that material. Then it's a waiver on the mass or the volume that would come out under the offtake agreement is waived. So it doesn't exist. So from that perspective, the remnant exists. There isn't like at the entire quota and then selling it into the JV. I just do want to get any more questions on that. It's quite simple the way it works, and the JV then has, the waiver of the tons. So going back to your original question, that's looking at the remnant and how long that we want to have these agreements for. Our commitment within Sayona, particularly in Sayona, Quebec, is to Quebec. We see it as a complete Quebec processing story. We have regular meetings with Minister Pierre Fitzgibbon. We understand his vision. We understand where he would like to see us all. He's a very pragmatic gentleman that knows that we all have challenges in the current market and fluctuations. So I think that has been accepted. The other side is that, there is, and talking to Keith, we certainly see the benefits of not having that freight, as Howard touched on before, having the ability to process the material and negate the significant freight charges to getting it to another processing, let's say offloading point. There's a reasonable saving in there for the JV. So there's no waiver of where we want to go at the point with downstream. My only conservatism, I suppose, is that, and Howard, you've seen them with Rodney before, and certainly not to say minimizing the challenges that people have had, but miners turning to chemical producers have always been challenging. And it's really how we can partner with a technology group that can bring that to the table. It's not like both of Petermont and ourselves say, well, we're going to be producing carbonate in 3 years. There's a couple of other steps in there to ensure its success, because the last thing you want to do is have capital overruns, time lags or delays, and then certainly not having the ramp up from a chemical perspective working in our favour. So it's probably a long-winded to discussion about offtake, but anyway, while we're on it, I thought we'd just sort of try and cover it all and see if there was any other questions from your side that drop out of that.
I guess there's also been queries around when the next feasibility will come out on the downstream.
Obviously, the trade-off study went through from that perspective. There's probably a couple of things that the JV needs to consider, and one of those is I think if Rodney and this is the problem when we don't have a market in equilibrium yet. We've seen. Look, I thought the price would come back. I know a lot of people are getting excited about $5,000 and $6,000 a ton for SC6, but when you look at sustainability and penetration into the market, and the fact of the matter is we're feeding into a very fixed price, let's say a fixed unit price industry, and mainly saying OEMs and EVs. So having a fluctuation, raw materials going up and down like that, it was challenging. And when we look at that perspective, and the DFS came out last year, and it still has a capital cost of $550 million, plus or minus 25% in order to deliver that project. Now, that's going to require a lot of thinking how we do it. It's not just, how do we fund that and how do we go about that? I think certainly from a lot of perspective and outsiders and government agencies, they want to see it happen and we want to see it happen. But is this the right time? And we've seen this in the market before where you don't want to, we're going through a ramp up process. How many things can we bite off at one time? So that's the feasibility study of the standard. So we've been tightening on the capital costs. I think the process that we've got is all there, but you saw the tolerances on the preliminary technical study for the or carbonate study for NAL was very wide, from 25 to 30% on the capital side.
Right, and there seems to have been some investor uncertainty around. There was a pricing adjustment in one of the quarters from the prior quarters that resulted in a lower revenue and profit, but it's the adjustment mechanism. It seemed to throw a few people out. Can you just sort of cover that?
Yeah, I think all of these contracts, Rodney, that's a good point because it was significant movement. It can move one way or the other. But what we would have from pricing is that, and I think most agencies report straight prices on SC6, and I'm really sure no one that I know is just sort of selling it. You can sell it under a reference or a pricing arrangement, but setting aside the auction material, but everyone that's buying is buying for the chemical derivative, whether it be carbonate, hydroxide, or anything below that. So they're fixing the price at a headline, and there's a qualifying period, which may be 30 days from loading to disport or whatever. And with the price plunged so quickly that qualifying period gives you an average at so many days at one level and an average of so many days reported by Fast Markets or BMI or SMM, any of those repositories for information sales, then determines the price. So when you have an incoming price coming in, and you saw it happen to both partners where there was the hit on the bottom line due to the drop in price over the qualifying period. And that's purely between when the price has started to when the price ends.
I guess, in the end, ultimately with mining operations, the all-in sustaining cost is really the key to these things. Is there a spodumene concentrate price that would trigger another strategic review if the market softened again?
Yeah, look, I think for lack of a name, and we review it every week on the weekly report to see where we're at. I mean, these things don't go on forever until you've got to look at sort of more, let's say, formative actions as to what you can and can't do. There's a number of things that we don't want to do in it, and there's sort of undermine confidence with all these reviews. I mean, we're always reviewing it, but there's a lot that probably I personally feel a lot on our shoulders as the only one, and we've got multiple pressure points. One, we've restarted NAL, and Howard touched on that earlier. I know when Brett and I spoke about it, we said we're really putting our neck on the chopping block here. It could be feast or famine in this regard. The second part is that Quebec has such a big role to play in the future supply of global lithium. And, there's a certain element of responsibility and demonstrated performance that I feel we have in order to make sure that industry doesn't get damaged by short-term market fluctuations. And I think the lesson from the 2019 and 20 and the price dropping, but dropped, consistently, but at a slower rate. Whereas we saw the acceleration of pricing in 2022, 23, and then the drop equally is, well, probably even quicker, where we started to see it rescind at a higher rate. So from us, I mean, we reported the cash costs, I think it was $1,008 US in the last quarter. That was higher than the previous quarter. So I think we've been able to demonstrate that if we can get the tonnage up, that we can get in a bracket of sustainable operations. And that's what the joint venture is looking at. It's not another review. It's actually giving us now saying, okay, we provided you with the capital to bring those operations and bring that tonnage up, bring the recovery up, and the recovery is where it needs to be. It's now the focus on the tonnage. And I said both of those items, or three of the key items that we've paid for with higher, more capital than we'd initially thought, starting to bite, and we start to see where those numbers are. So it's a fact that it needs to be, cash neutral at best to make sure that it's sustaining and, from an operational standpoint, because it's, we just can't throw money at something and don't see any line of sight from the end. The other part is, how many tons, when we sell them, moving through that's the JV negotiations we work through. And for the moment, it's been reasonably good. And I don't see any reason why it wouldn't continue that way. We've got I think there's probably a general perception that we argue. There's no point arguing with your partner, and there's no point bringing out a JV agreement every time we have a hiccup. We work our way through things. And I think there's a pragmatic approach from both sides. But we are both, the essential part of what we do is to work in the best interest of the joint venture. And that might mean a bit of give and take on both sides. So I think we've been shown that we're willing to do that.
Both Sayona shares and Piedmont shares have been under pressure because there's some equity overhang risk. If your all-in sustaining costs are $1,008 last quarter, you're striving to get to the DFS level, of 710. It sounds like that's a target sometime by Q4 of this year. You've talked about the second half of this year. So all of that is being, implemented. But I wanted to go to your offtake comments about, like, if you're at 190,000 tons production and 113,000 goes to Piedmont, then there's 77,000 tons left over. You say that those are not Sayona tons; those are joint venture tons.
Yeah, that the joint venture has the rights to sell those tons. So I just want to separate Sayona as the parent company. We're 75% shareholders of the joint venture, so the joint venture sells those tons, not Sayona.
Okay, but if Sayona, because there has been questions about why don't you sign an offtake, like Piedmont signed an offtake for some of their tons with LG and got, $75 million for that for a period of time. Why doesn't Sayona, offtake? I know you don't know the exact tonnage, but if it's not 77,000 tons, if it's 40,000 tons for 3 or 4 years before you kind of go into carbonate, because it sounds like that 2026 year on the carbonate, you said Pierre Fitzgibbon is understanding, the markets, and it's difficult, minor to chemical. I'm sensing maybe that 2026 target, might be a little bit later in the future, but we're here in 2024. If you needed to, right? You sold some of your Trolia shares to raise, $10 million. If you didn't want to do an equity raise, is there scope to use some tonnage for some period of time from the Sayona joint venture to get some capital outside of doing a capital raise?
Definitely, Howard. I mean, this is a decision the joint venture makes. I mean, both parties could propose together, and I haven't, I wouldn't say, I'd be a liar if I said we haven't discussed this at length. I mean, we're looking at where we could place it, how we could place it, where we could put it there, how long. We don't undermine the downstream process, which is real and our intention. No, that hasn't wavered. But certainly from that perspective is bringing someone in. Now is the point of, getting some of these agreements in place that would supplement that. But there's also a larger opportunity as well with Moblan that we haven't really discussed, which is conceptually, you'd only have to imagine that what one of the things I think most people face these days in identification of resources is how long it takes you to get to the market. I mean, the approvals process is not simple. I'm not saying it should be, but there's certainly an element of uncertainty when it comes to approvals process of new projects. Now, we see from a Sayona perspective having access and the ability to expand NAL, and also having Moblan as a standalone project, be able to dovetail those together adds to the complexity, but that's not an issue for the JV because only one of us have an interest in Moblan at the moment. The offtake is real. There's a number of obviously tests and cargoes ported to people in order to see where that can go. We want to maintain obviously our IRA compliance in regards to that too. I mean, at the moment there is a general consensus from Quebec that they understand, particularly where from a government perspective that we need to sell into North Asia. It's whom we sell that to, and some of those niche markets where you do get a better price. And looking at some of those pricing forward ahead is based on having people that really want to be exposed to having this product. So in short, Howard, yes, it is very real that we can, from a joint venture perspective, and have been evaluating whom we could sell it to, what type of deals we could do, what that means for the JV itself, the longevity of these projects, and what, how they can be rounded out. So it is let's just say you could sell a minimum of 40, maximum of 80,000 tons for the first 12 months up to, you can put a variance around that. So you're correct. It is an opportunity there for sure.
And then those tons would be 75% to Sayona and 25% to Piedmont?
Yeah, in essence, yes, Howard, because in the end, the money would go to the JV and any repatriation of loans or funding would come out of the JV, but that would be the proportion. But they would be JV funded because it's NAL that would sell it.
Okay. And to the extent that you would find an offtake partner that was non-Chinese, because right now the price Sayona is getting specifically, and Keith has alluded to this as well, the LG and the Tesla deals seem to be better pricing than, selling it to the traders, and your pricing has been quite lower, I think, as well for your tons. To the extent that you're dealing with a Western offtaker who cares about IRA compliance, is there, Keith has talked to the strategic value of this asset, right, as the only North American, spodumene supply. And, there should be an incentive for IRA compliant buyers to want to make sure that this mine continues and succeeds. And in order to do that, floor pricing, as you had at Altura, which we won't get into, the Chinese partners didn't always keep to those floors. But if you have a Western partner with a floor, is that part of the, it sounds like you have active discussions going on. Is that do they recognize, in the way that GM, I think, recognized with Lithium Americas, this is important. We're going to give you floor prices that will keep you in business. Is that something we could look forward to, do you think?
Yeah, look, I think Howard, most of the forward thinkers, when it comes to, previous thinking in the last reiteration of lithium developments it was every man for themselves, so the market takes a turn. So the buyers are winning and the sellers, the operators are losing, and no one cared if you went to the wall or not, because they figured, well, we'll just pick up where we left off when we need to. And I think the damage done in the last cycle and there's been a lot of, let's say, integration of operations since then. It's a very strange thing now. You've got operations in Western Australia building, hydroxide and operating hydroxide plants outside of the PRC. And And don't get me wrong, it's not, I'm not here to bash the PRC. I've got a lot of great friends and in the business there, and we all have, and they've been dominant because they have the technology and the ability to produce chemicals as and when required, whereas we're ramping up. But outside of that North Asian market, and looking at that, and that's what we're looking with strategics at the moment, is saying this is where we're at, this is where we need to be. Ideally for some of the the higher yielding markets are very smaller. They're ramping up. I mean, Tesla's not at that rate yet where it could take any more material. We're heading, I think the case probably alluded to the railing down to Corpus Christi commencing shortly, and those things are starting to integrate. So it's just the tough time in this 6 months where you're going through accreditation. There's doubt over what the product looks like. We're working our way through chipping away at that and getting it into it. And we've seen products, I mean, when you see the auctions, I mean, I saw Pilbara auctioning, under the BMX for basically $1,100 a ton in Q4. We saw the Albemarle tonnage, which I think was located in China, for about 1,200. So there is groups that are taking, to your point, that are looking at sustainability over just, price taking, and they're looking at the bigger picture. And you're correct. Those are the targets where you need to be. They may not be North Asian, but they may be closer to the mark here from an IRA perspective, but they're still, obviously not taking, they've got to have the ability to absorb the additional tonnage that they're already signed up for in that case, and certainly to get into that market. But you're right, Howard, the challenge is to get that into a lower floor so that you're always a profitable, a tonnage coming in of NAL. And I've said to the people, it's my only goal whilst to stay with Sayona is to see every ton from NAL a profitable ton.
Okay. And you mentioned Tesla. That I noted that in your quarterly that, first shipments from, that's very important, right? Localized supply, not going to China, so from Quebec to Corpus Christi, I take that as a good sign. We've seen a lot of layoffs and other noise coming out of Tesla recently, but the fact that they're taking material for Corpus Christi leads me to believe, hopefully, that their hydroxide plant is getting ready to at least start commissioning sometime this year.
Yeah, you're right. And as I said, I think some of the more long-term partners, and I think people that are looking ahead, and Tesla always have, and personally, we all know people that have either been there or still there and working through the supply chain with us and understanding, I think, from the way they've always operated in the EV range, or solely in the EV range, have been forward thinkers. And I think, as I said, the challenge is for us to get to a cost point and a price point for the buyers whereby the penetration rate doesn't end up being interrupted. And we've seen this before where we're having wild swings from inventory movement. When we had a heap of inventory and raw materials, now it goes to battery pack sitting on the other end. It's the equilibrium in the market that allow us to settle down, make each part of the process profitable, and allow for growth in a normal, sustainable fashion. And that's not waking up. And I'm sure you do when you read a major OEM announcing a revised downwards EV penetration or production output, rethinking their strategy. I mean, we've got to be able to build that confidence across the sector so that people are willing to invest and continue to invest.
And then talking of that, something was just about the past in terms of information distribution and so on. If you can round up for investors on the assumption that market conditions remain favorable and, around these levels or better, what the key milestones are to look out for in 2024?
I think certainly hitting consistently, if we've got a quarter of nameplate at NAL, is really, that's the light at the end of the tunnel. And, we didn't touch, Howard mentioned the cost structure before, and it gets to a lot of these fixed costs just being divided by more tons. It's as simple as that. And I think that's the low hanging fruit from there. I mean, it's not doing anything too creative. It's the fact of getting those tonnages through, and that's the task in front of us. I think certainly our decision making on Moblan, where we, it begs it is a partnership now. It's a joint venture between us and Investment Quebec. We haven't touched on it yet, but it's a strange story, I suppose, because Moblan there was a lot of activity in the northern part of James Bay there that we saw, and Moblan was considered just a little postage stamp, and it's come out of, the identification of the flat-lying pegmatites is something that we're hoping we'd find more, because when we bought it, we only had 12 million tons of fairly scant resources there, but looking at a 70 million ton resource now, including the inferred, and 50 million of that, certainly in the measured and indicated, I think there's some progress to be made on that. There's no secret that the DFS was based on a truncated database for timing matter, to match the timing that was set for release. So the integration of the 60,000 meters from the late 2023 campaign will be, I think, a highlight for Moblan, for people to get their idea around, what is the upside here and what are we looking at. So I think that will be a good delivery. Certainly offtake from NAL, from the cost structure, and having some stability around that would be a milestone that to deliver positive results. And for Moblan as well, I mean, it begs, it's fairly advanced. It's the most, how would I say it? I would say it's the most ideally located deposit in the northern part of Quebec and James Bay. So we're only 4 kilometres from the highway and easy access to the railway line. So, and to port, once we get to the rail in that region, we're okay for port access. Although the timing of Moblan would tend to me to be an internalized, integrated operation. So I think any movement on those would be really, really good. And I think, clarity, I think from any investment perspective, we have people that invest because projects are in exploration and there's regular updates coming out. We have that sort of lull, I would say, when you close off the DFS before there's a formal investment decision. So any milestones as you move forward through that in regards to funding, definitive, funding arrangements to bring that to market in a timely and rational manner, I think would be positive.
Okay, great. I'm looking at your stock chart kind of year to date, and everything fell aggressively, in January, but then you had this very sharp spike in price for a very short period of time. And then Piedmont, hit the bid, and, some of your Sayona shareholders were upset because it took away a lot of the momentum in the share price. So it fell on that news. I mean, Keith has talked about this opportunistically. That was how he did his capital raise rather than raising equity. There was some thought that, maybe you were unfriendly. I think you shared through this interview that you're on very good terms in general with your joint venture partner. But spodumene prices have been rising since they sold their shares. Your quarterly showed an increase in cost, but the momentum and the trajectory of your March numbers are quite good. Why do you think, some other stocks have rallied? We've seen, the scoreboard, we could put up the scoreboard here now, April 30th, I mentioned, among the spodumene producers have kind of like leveled off, like Pilbara and Minres. And then among the emerging developers, there were some green shoots, and some bloody noses, I said, among those. You've been among the bloody noses, in the last month. But your quarterly's out. We do know Andrew Barber from Allchem. I hadn't realized that you made that appointment. There have been a lot of questions from some of the shareholders as to what are you going to do to get the kind of message out from an investor relations perspective. I mean, I guess this detailed video is the first time that, you've done this in a while, but what could Sayona shareholders, I guess, like the market cap now is 329 million Australian, like 250 million US. It's a similar valuation to kind of Piedmont, right? You could look, you have the joint venture, and then you have Moblan, they have, Atlantic and other things there. But Anyway, any thoughts on that, and any thoughts maybe as well? Are you? And I asked this question to Keith. Is he worried that the Gina Reinhardts, or the Chris Ellisons of the world can kind of creep onto the share register, and pick up something cheap? What's your sense on that?
Yeah, you got a few questions in a tangle in the how, but I'll do my best to avoid and if any CEO in the business says, "Are you undervalued?" Yes, I think there's complexity within where we sit, and there's uncertainty around NAL, what it will be and what it costs. Because if you produce quarterly reports 2 quarters and your funds are going down, it's not a good outcome for positive investment. And there's the other side is, I won't comment on, Keith made his, the Petermont decided that, they divested both out of Atlantic and Sayona. We would like them to stay there. It was good, but obviously though there was reasons that they chose to do that, and it's not for me to challenge those, and I never would. I suppose the difference, I don't want to say that I don't want to give the impression that we won't fight for what we like. But I think as a group, I think we're quite focused on what the outcomes are. So each one stands up for their own rights, but I think we conduct ourselves in a reasonably, let's say, decent manner. I think, we've known each other before and we'll know each other after this. So it's only the time we're together that matters. There is, there's no doubt that we track each other, and both of us have been tracking. There is some discords in the pricing between Piedmont and Sayona. But if you look at the overall trend, we've been, and you look at the obviously our advisors provide us with weekly updates. If you look at the carbonate or look at the lithium index price and look at us, we do track very much close to that. If it drops 20%, we're down 25%. We've been hit harder. There was a spike there, as you said. It was, nothing we're proud of, because we can see where the numbers are and see where it's got to. And, as I said, all of the boards invested in Sayona so significantly. So we feel everyone's pain in that regard. As far as, the options are open for all of us to continue through what we have and where we see it. I think that there's no doubt that the market sees the offtake with the Piedmont holds at NAL to be swayed in Piedmont's direction. That's the value, and we all know what broker consensus values look like in that regard. So we're not naive in regards to potential value shift. From any joining of forces. So look, I think, and Howard, I've probably spoken to you before, and Rodney, that ultimately there's still further consolidation to go in the market. I think that's inevitable as we move through. I think the other part is, particularly for ASX listed entities that have discoveries in North America, particularly, Quebec Quebec particularly, and in Australia, when we look at the rise of the Azuras and we look at Wildcat and those numbers around discovery, that's where it seems the investment seems to move. And we found this before, that operations, and particularly a story like ours, and you could say, well, preempting talks, could you float off or divest assets into other vehicles? Sure. But it's ascertaining why people are there, and people came in, and the timing of when people were coming into to lithium. If you came in at 1 cent, you're feeling hurt, but maybe you didn't sell out at 30 cents. We're all in the different boat there. But I think from that perspective, there is numbers around operators. There's blue sky that sits on the developers. So at the moment, if you're in the development camp, if you had Moblan on its own, then you'd do a direct comparison to, say, Patriot and Corvette. You could do any of those larger sort of deposits that are getting up towards 100 million tonnes, and there's intrinsic value there. The DFS coming in February, Howard, has an $800 million capital number on there. So, as I said, once you put that out there, your numbers are out. So everyone's looking at discovery, but no one understands what you got to bring that to the market. So we're firmly on the side of the fence of having, we've got tremendous blue sky, but we've certainly topped and tailed our operations in regards to where our cost structure looks like and where the market timing is. And we're certainly post DFS at Moblan. And I just want to caution the DFS is, it's a line in the sand and allows a lot of scrutiny and a lot of partnerships and a lot of milestones to progress in regards to who you would like to partner with, because we do have a DFS now there. There's, obviously bulk testing, there's everything that hangs off that. So people can have get their teeth into that. But it is quite friendless in the market when you're in that lull between one and the other. And we could add, we'll be adding exploration results and increasing mineral resource estimates. But, it's just where the sentiment moves, and there's a lot of retail in this market. And, we've got to convince people this is a solid investment.
Yeah, look, the SON curve we always point to, there's that exploration, and then there's the going into production, and then there's that kind of middle period. Moblan never really had, that exploration
No, it
uplift
didn't.
necessarily within your company, but you never got that real re-rating as you went into production because, lithium prices have gone down. You've not made the money yet, but as spodumene prices hopefully have stabilized and hopefully will continue to rise, at least a little bit, maybe, more substantially. And if we get those costs down and closer to 700, you should start to be priced as a producer. If you're at least, kind of like you have the most leverage to price are the higher cost producers. So, Matt Fernley has said that, Rodney said that, so there's real scope, and we've seen a number of stocks on the scoreboard in certain months, go up 50, 100%, in any given month. And that I think could happen here, not investment advice, obviously. If you hit some of the milestones as you articulated, especially, on the North American lithium side, this year. There was a couple more questions. Tabba exploration. There was just some, do you want to comment on that?
Yeah, sure. And I think probably these are things that, and how I'd appreciate you winding that in, because the tenements, whether they're in the JV with Morella or the standalone with Sayona, are very strategically located. We've obviously, both companies been working together on a number of development or exploration strategies for the region. I think particularly Tabba East and Tabba itself. So we're talking about 2364, the exploration license, or 4705, adjacent to each other. Those programs are kicking off as soon as we can get clearance from our traditional owners there. That's happening as we speak. So we've got our people out in the field, and Simon's been there ready to go. So I think, fingers crossed, that will show some upside. Again, we're hoping it doesn't get lost in the weeds, so to speak, any positive results out of that. But, the approach from the JV has been to drill out the pegmatites in the Malina. So that's the Sayona and Morella JV. We'll move to Mount Eden in that perspective for the JV as well. And also the Tabba conjoined areas. So if you look for tenements in Australia at the moment, or mining claims that you want a location in discovery, I think that's the place you want to be. So, we'll push those through. And obviously, certainly there had been a previous focus on a lot of gold work, where, that's fine. But in essence, we've got some ideal spodumene outcrops all through those tenements there. And we're obviously getting proof of plan and putting more numbers together. So that'll be happening, and news flow coming out in the coming months for sure.
Just, I'm not familiar with Tabba, and you said it's a joint venture with Morella. What's the ownership, Sayona Morella, on Tabba?
We had a historical joint venture from 2018 between the two groups, and it was, obviously previous it was Sayona and Altura. So, it was, in place and reignited and restarted. So there's a number of tenements in Western Australia that are 51% now at completion of an earn-in by Morella, 49% Sayona, so basically 50-50. One of those tenements is we call Tabba East, and then Sayona in its own rights has the rights to the lithium in a tenement which is immediately adjoining that on the western side. So both of those two are located, let's say, southeast along the shear zone from the Tabba operations, which are now Wildcat Resources.
Okay. And there was some question just about the ownership. You mentioned the directors have significant shares in Sayona. I haven't really seen that or examined that, but yourself or Alan Buckler and some of the others, the stock's cheap. We haven't seen Atlantic, we've talked about, has been one of the few companies where the board has been on market buying, any prospect of that or again, these were investor questions we wanted to bring up.
I think it's sort of a double-edged sword, the question, Howard. Yeah, it is cheap. And no doubt that there's not an inclination, but we've got to be in a window where we could do so. And I can't say more, but there's nothing worse than, buying, we've had DFSs coming out, we've got quarterlies coming out, we've got upgrades coming out. There's a very narrow window there where we could. From our perspective, we did exercise. Alan exercised 10 million options. I exercised 10 million options. Paul Crawford exercised 20 million options in late July last year at 15 cents. So we've put, that was $6 million between the three of us have gone in. And I'm not saying, that's not to say, look, we've got nail holes in our hands or anything like that. The fact is we are invested. We've continued to put money in and we believe in the story. The market will take care of where, we got to look at it from a long perspective. The messages to me, and certainly, walking into I wouldn't say the lion's den, but walking into a we have a fairly, I would say, a really active shareholder registry from our retail groups, particularly. We enjoy some of the interaction. Well, it's good to get the messages because people are feeling free, to communicate with us. We generally do get a lot of questions that are based around, obviously there's a lot of discussion groups because we'll get, 15 emails potentially with the same question in the same words, and we work our way through that. But, the company's going to outlive us, and we need to be custodians and put it in the right hands at the right time.
I hadn't realized $6 million at 15 cents. That's real money and severely underwater at the moment.
Yeah.
Would you consider a stock consolidation because you have a lot of
Yes.
shares outstanding?
Yes, definitely, Howard. So I spoke to Andrew about that. I mean, I don't want to cross over, disclose it hasn't been agreed by the board, but certainly in this position, it would be a company of the size of Sayona would make sense to do so.
Okay, great. This has been we've been here nearly an hour and 25 minutes. James, really detailed discussion. I don't think we've missed much. I do want to ask, actually, go back to the OTA, right? Originally, when we spoke to Brett Lynch 3 years ago, the whole plan was to kind of blend OTA with the North American lithium ore. You still need to get that permitted, I guess, from a mining perspective, but there hasn't been much discussion, I guess, about that.
Yeah, I think, Howard, it was always going to integrate into NAL as a supplementary ore feed. It's located, about 8 miles over to the west of where we are. But that was based on what we initially had seen at NAL. And I know historically when we did look at NAL, and it was very limited to what we could see, and it was quite a risky purchase for both parties at that point in time. We learned a little bit more. So what we've done since is obviously drilled it out, looked at our permitting, looked at the quality of the ore coming in. And we do think that need to integrate OTA is somewhat, not in the next 3 to 5 years. It's beyond that. So it still requires permitting. It's going through the BAPE, the BAPE process at the moment. So as I said, everyone approaches things with caution, but for me, particularly Quebec's got some. People forget how heavily, it is reliant on mining with the gold operations around us. I mean, particularly around NAL and up through Val-d'Or. Obviously, the meaning of that is Valley of Gold. So we are quite cognizant of the timeframes to get new projects approved, and everyone should be, because it's not there's no certainty around what may or may not happen. So we're dealing with several interested and integrated stakeholders.
Okay, great. No rush. Okay, so that original plan is further into the future. North American Lithium has its marching orders, I guess, with the current plan, and hopefully we get that down to $700 or so. Okay. I think, thank you very much, James. This is a great, thorough interview. I hope all Sayona shareholders, are appreciative of this. I remember, I don't know how many you said, 50,000 or 40,000, 45,000 retail shareholders, and there's a number of institutions in there as well. Look forward to further progress and with the IR group, maybe a number of investors were asking for updated presentations, setting, milestone checklists and the like. Knowing Andrew as I do from the Allchem days, I'm sure investors will be happy, in the coming months as that strategy unfolds.
Yep. And appreciate that, Howard and Rodney, for your time. And as I said, we're working on it. There's a number of things. It doesn't all happen in a day, but we're getting the resources where we need to be. We're certainly cognizant of what people require and trying to fill that in a meaningful fashion so people aren't second guessing where the company goes. And a lot of it's very clear and very straightforward. We live in a different world. I'm saying I'm playing the back nine now, but social media plays a big part of what's true and not true, as we've all seen. So we just got to make sure we get on the front foot and make sure that we get the right message out there and it's clear and concise.
It's a fairly liquid share, and it's again, very active following. But hopefully this conversation clarified some things. I'm sure we'll see in some of the comments. Maybe there'll be some more confusion. I don't know, but we'll address that. But thank you for your engagement, James, and look forward to. Actually, you're in New York. I may pop in and meet you for coffee tomorrow or Friday and share that on X.
No problems.